Hey there, financial adventurers. Welcome back to the channel where we decode the fascinating world of how to borrow stocks and potential short squeezes. Today, we're putting a specific microcap company under the microscope, one that's recently appeared on our hard-to-borrow screener, ZCMD, Inc. We're going to break down what makes this stock interesting from a borrowing perspective, the mechanics of a squeeze, and what you need to know about its unique situation. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, who is ZCMD? Inc. is a small-cap player in the healthcare and health information services sector, specifically operating in the People's Republic of China. They provide healthcare information, education, and training services to medical professionals primarily under their MDMIC brand. With a market cap currently sitting around $6.06 million, ZCMD is definitely in the microcap category, which often means higher volatility. Their business model includes MDMIC services and the sales of patented drugs. What is cost to borrow and why it matters? Before we dive deeper into ZCMD, let's quickly explain a critical term, cost to borrow, or CTB. When you want to short sell a stock, you first need to borrow shares from someone who owns them. The cost to borrow is the annualized fee you pay to rent those shares. Show animation, arrows from lender to borrower, then borrower to market sell, then an arrow back from borrower to lender labeled CTB fee. Think of it like renting a car. The more in demand the car, or the fewer cars available, the higher the rental fee. A high CTB indicates that a stock is hard to find, hard to borrow, and therefore expensive to short. It can also signal high demand from short sellers who are willing to pay a premium to bet against the company. Why this stock is hard to borrow right now. Now let's talk about why ZCMD is on our radar. Our screener shows ZCMD with an eye-popping annualized cost to borrow fee of 846.6%. Show text overlay, CTB 846.6%, that is not a typo. This incredibly high fee suggests that finding shares of Zhongtou to short right now is extremely difficult and expensive. While we don't have real-time data on the exact shares currently available to borrow, a CTB in this range screams scarcity. The estimated float for ZCMD is quite small, at approximately 1.1 million shares. A small float means fewer shares available for trading, and critically, fewer shares available to borrow. Our internal composite squeeze score, which factors in things like CTB, float, and momentum, sits at 47.5 out of 100 for ZCMD, indicating some interesting underlying conditions. Squeeze mechanics explained. So, what does it mean for a stock to be hard to borrow? It means short sellers who want to bet against ZCMD have to pay that hefty 846.6% fee just to maintain their position. Show graphic, short sell process. If the stock price starts to rise, these short sellers face a double whammy. Their short position is losing money, and their borrowing costs are eating into any potential future profits. If the price continues to climb, or if the borrower supply shrinks further, some short sellers may be forced to cover their positions. Show graphic, short covering process. Covering means buying back the shares they borrowed and sold, returning them to the lender. This forced buying creates additional demand for the stock, which can push the price even higher, trapping more short sellers, and potentially igniting a short squeeze. Dilution risk check. One critical factor to consider in any short squeeze thesis is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. Geographic dilution, more shares, less value per share. This could flood the market with new supply, making it easier for short sellers to cover their positions and suppressing any potential price increase from a squeeze. We've checked for ZCMD and found no recent dilutive SEC filings like -1s, -3s, or 424BS in the last 90 days, which is a positive sign for the short squeeze narrative. Recent reverse split watch. Now, this is an important detail for ZCMD. The company executed a 1-for-3 reverse stock split on June 29th, which was exactly 38 days ago. Show text overlay, reverse split, 1-for-3, 38 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For example, if you own 3 shares at $1 each, after a 1-for-3 reverse split, you'd own 1 share at $3. This effectively reduces the float even further. Historically, we've observed that many microcap stocks tend to see renewed volatility or price pop within about a month after a reverse split. While ZCMD is just outside the typical 1-month window, this historical pattern is worth noting, though it is a tendency, not a guarantee. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at ZCMD's recent price and volume action. Today, the stock is down 8.47%. Over the last 5 days, it's seen a decrease of 4.42%, and looking at the past 30 days, it's down 1.10%. Should chart ZCMD price action. This recent price performance suggests there hasn't been significant buying pressure yet despite the high CTB. Today's volume for ZCMD is 2.4 million shares. However, this is significantly lower than its 30-day average volume of over 10.7 million shares, giving it a relative volume of only 0.2x. This low relative volume indicates a lack of current trading interest. For a short squeeze to gain traction, we would typically look for a sustained increase in buying volume pushing the price upwards. While the high cost to borrow suggests pressure on short sellers, the current price action and low volume show they haven't been forced to cover en masse yet. It's also important to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have strong conviction in their bearish thesis and are willing to pay the high fees to stay short. John Cho Inc. ZCMD presents an intriguing profile with its incredibly high cost to borrow and small float, combined with its recent reverse split. These are the ingredients that can create conditions for a short squeeze, though it's never a certainty. Remember, the market is complex and unexpected events can always shift the narrative. Always conduct your own thorough due diligence, understand the risks involved, especially with microcap stocks, and never invest more than you can afford to lose. If you found this breakdown of ZCMD helpful, please give this video a like, subscribe to the channel for more hard-to-borrow insights, and let us know in the comments if you have any questions or other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next one.